All right, so you ready to dive into some high-yield dividend stocks?
Always ready to dive into dividends.
You know, listeners are probably here because they're looking to build a portfolio that, generates some serious passive income.
Yeah.
Right?
Of course, who isn't?
So we're checking out this article titled 3 Ultra-High-Yield Dividend Stocks to Buy in November and Hold Forever. Hold forever, though.
Yeah.
That's a pretty bold statement.
It is.
Especially when you see yields above 9%. Right?
Yeah.
What are the risks and rewards that we really got to understand here before we even think about, diving in?
Well, that's right. It's a catchy headline, that's for sure. And while those yields are certainly tempting, it's important to, approach them with a healthy dose of skepticism.
Yeah.
Remember, risk and reward.
Yeah.
They go hand in hand when it comes to investing.
Exactly.
Always.
So for those of you who are already familiar with dividend stocks, we're going to go, a little bit beyond the basics today. But as a quick refresher, dividend stocks are essentially companies that share a portion of their profits directly with shareholders.
Right.
Typically every quarter.
Yes.
And they've historically tended to outperform non-dividend payers.
Yeah.
This article even mentions that dividend-paying stocks in the S&P 500 averaged an annual return of 9.17% over the last 50 years.
Wow.
Compared to just 4.27% for non-dividend stocks.
Huge difference.
Yeah, so huge difference.
Yeah.
But of course, past performance doesn't guarantee future results.
Absolutely. And it's crucial to remember that those ultra-high yields, while they sound amazing, often come with higher risk.
Yeah.
It's like anything else in life. If it seems too good to be true, it probably is.
Yeah.
You need to understand why these yields are so high. Are these companies undervalued by the market?
Yeah.
Or are they struggling in using high dividends to attract investors?
That's a great point. And of course, we are not offering any financial advice here.
Of course not.
This is purely informational and educational.
Yeah, we're just exploring.
We're exploring the intricacies of these companies and understanding what makes them tick.
Yeah, we're your guides to the information, but the ultimate decision is yours.
Right.
Whether to invest or not is always yours.
Exactly. Now, 2 of the companies featured in this article are business development companies, or BDCs.
Yes.
Now, instead of diving straight into the specifics, can you explain what a BDC is and what makes their dividend payouts unique?
Sure. Think of BDCs as the specialized lenders filling a gap that traditional banks often leave open.
Yeah.
They provide financing to small and medium-sized businesses that might not meet the strict criteria for conventional bank loans.
Okay.
Now, to avoid corporate income tax, BDCs are required to distribute at least 90% of their taxable income to shareholders as dividends.
Wow.
So these high dividend payouts are practically built into their business model.
Interesting. So it's not just about generosity, it's a tax strategy.
Exactly. And the third company we'll be looking at is a real estate investment trust, or REIT. Like BDCs, REITs also have a tax advantage when they distribute a large portion of their earnings as dividends. But instead of lending to businesses, they own and operate income-producing real estate.
Okay, so we've got 2 BDCs lending to businesses and a REIT in the real estate game.
You got it.
Got it. Now let's jump into the first company on our list. Ares Capital boasting a 9.1% yield.
Impressive.
And holding the title of world's largest publicly traded BDC. That's impressive to say the least. Where do we even begin?
Well, let's start by unpacking what makes Ares Capital tick.
Okay.
Like we discussed, they operate in the BDC space, providing financing to companies that might carry a bit more risk than those favored by traditional banks. This higher risk tolerance helps explain the higher potential return reflected in that 9.1% yield.
So they're not afraid to play in a riskier pool.
That's one way to put it, but they're also strategic about managing that risk.
Okay.
They boast a highly diversified portfolio of 535 borrowers, with their largest investment representing just 1.7% of their total portfolio.
Ah, the good old don't put all your eggs in one basket approach. Diversification is key.
Exactly.
But what about the specific types of businesses they lend to? Are there any particular industries or risk factors that stand out in their portfolio?
That's a great question.
Yeah.
And it's where the real deep dive begins.
Yeah.
Looking at their portfolio, we see a focus on senior secured loans, which means they have first dibs on a company's assets if things go south.
Right.
They're spread across various sectors from software and healthcare to consumer goods and energy.
Wow.
This kind of diversification helps mitigate the impact if one industry faces headwinds.
Makes sense. It's like a safety net woven from different threads.
Yeah.
So diversification is one way they manage risk.
Yeah.
What other factors contribute to their seemingly stable position?
Another important metric is their low percentage of non-accrual loans, which are essentially loans where the borrower has fallen behind on payments.
Right.
As of September, only 1.3% of their loans were on non-accrual status.
Okay, so that indicates they're pretty good at picking borrowers who can actually pay them back.
It seems so.
But what about their track record in terms of dividend payments? How have they managed to maintain such a high yield over time?
The article mentions their dividend has grown about 26% over the past decade.
Wow.
Though not in a straight line.
Okay.
Now, while consistent dividend growth is generally a positive sign, it's important to understand why those fluctuations occur.
So it's not just about the numbers, it's about the story behind those numbers.
Yeah.
What might cause those dips and rises in dividend payouts?
Well, dividend payouts can fluctuate due to a number of factors.
Sure.
Changes in the company's earnings,
Right.
overall economic conditions,
Yeah.
even strategic decisions.
Right.
For example, Ares Capital may have adjusted its dividend payouts in response to the pandemic's economic uncertainties or shifts in interest rates. The key is to look beyond the fluctuations and assess the overall trend.
Okay.
Is the dividend sustainable in the long run?
So one dip doesn't necessarily spell disaster.
It's all about context and the bigger picture.
Exactly. And with Ares Capital, we see a history of carefully managing their portfolio and adapting to market changes.
Yeah.
They seem to be in it for the long haul, which aligns with that hold forever concept from the article.
Right.
But like with any investment, there are always potential risks to consider.
Right, like those interest rate hikes we've been seeing. Didn't the article say something about the Federal Reserve potentially lowering rates soon? How might that impact a company like Ares Capital?
That's a great point.
Yeah.
Lower interest rates could potentially impact their earnings,
Okay.
as the interest they earn on their loans might decrease.
Yeah.
However, it's not always a simple equation.
Okay.
Their cost of borrowing would also likely go down,
Right.
which could help offset some of those losses.
Ah, so it's a balancing act. Lower rates might squeeze their margins on one hand, but lower their expenses on the other.
Exactly.
It's a reminder that the economy is a complex web, and these things have ripple effects.
It is. All right, on to company number 2, PennantPark Floating Rate Capital.
Oh.
Now, this one caught my eye because the article claims a whopping 11% yield paid out monthly.
Wow.
That definitely raises an eyebrow, especially given our conversation about risk and reward. What's the story with PennantPark?
PennantPark is another BDC.
Okay.
So they operate in that same space of lending to businesses that might not qualify for traditional bank loans.
Right.
However, their strategy is a bit different from Ares Capital.
Okay.
They specialize in floating rate loans.
Floating rate loans. Remind me how those work again.
Sure. With a floating rate loan, the interest rate adjusts periodically.
Okay.
Typically in line with a benchmark rate like the prime rate, it's similar to an adjustable rate mortgage.
Gotcha.
So if interest rates rise as they have been recently,
Right.
PennantPark's income from those loans increases as well,
Okay.
which can help protect them from inflation.
So they've essentially built in a hedge against inflation. Smart move.
Wow.
But the article also mentioned the Federal Reserve possibly lowering rates soon. Wouldn't that hurt PennantPark's earnings if their interest income goes down?
It's a possibility, yes.
Okay.
If rates fall significantly, their income from those floating rate loans would likely decrease.
Right.
However, it's not a foregone conclusion that their earnings would plummet.
Okay.
Remember, their own cost of borrowing would also go down,
Right.
potentially offsetting some of the impact.
Okay.
Plus, they have a history of being quite selective with their borrowers. As of June 2024, the average yield on their debt investments was 12.1%.
Wow.
That's a healthy margin.
So they're not just throwing money at any business that comes knocking. They're choosing their investments carefully and pricing those loans to maintain a strong return, even in a fluctuating rate environment.
What about their dividend history? Have they managed to consistently deliver on those high payouts?
Your dividend history is actually quite interesting.
Despite the potential for interest rate fluctuations, they've maintained or even raised their dividend payments quite consistently since 2015.
Wow.
With one brief exception in 2018, this suggests they're confident in their ability to generate consistent income and reward their shareholders.
That consistency definitely speaks volumes. It seems like they've found a model that works for them, even in the face of economic uncertainty.
Indeed. And while they might not be as large as Ares Capital, their strategy of focusing on floating rate loans and carefully selecting borrowers seems to be paying off.
All right, 2 BDCs, down 1 REIT to go. What can you tell us about Rithm Capital? I'm intrigued because they're a REIT with a twist.
Rithm Capital is indeed unique.
Yeah.
They're a REIT, but instead of owning physical properties like shopping malls or apartment buildings,
Right.
they invest in mortgages and mortgage-related assets.
Okay.
Think of them as playing the role of a specialized financial institution focused on the mortgage market.
Okay, so a mortgage REIT. Can you break down what that means in simpler terms? What exactly do they invest in?
They're involved in a wide range of activities within the mortgage ecosystem.
Okay.
They originate mortgages, service them, invest in mortgage-backed securities,
Okay.
and even own and manage single-family rental properties.
So they're not just buying and holding mortgages. They're players in the entire game.
Yeah.
How does that strategy benefit their investors, especially in terms of dividends?
That diversification within the mortgage market is actually one of their strengths.
Okay.
It allows them to spread their risk and potentially benefit from different segments of the market, even during times of volatility.
It's like having multiple irons in the fire. If one area of the market cools down, they have other areas to pick up the slack. But diversification aside, what about their dividend history? Has it been as smooth sailing as the other two companies?
Their dividend history has been a bit more of a roller coaster, to be honest.
Okay.
They lowered their dividend in early 2020, likely due to the pandemic's impact on the mortgage market. But since then, they've raised it twice. The current yield sits at a very respectable 9.5%.
So they took a hit, but bounced back. Resilience is a good quality, especially in today's unpredictable market. What else stands out about Rithm Capital?
There's one detail from the article that I found particularly intriguing.
Okay.
The article mentions that Rithm Capital's book value, essentially the total value of their assets minus liabilities,
Right.
is estimated to be around $6.4 billion.
Okay.
But their market cap, the total value of their outstanding shares,
Back.
is only $5.5 billion.
Wait, so they're worth more on paper than the market currently values them at.
Yeah.
What's going on there? Are investors missing something, or is there something else at play?
That's the million-dollar question.
Yeah.
This discrepancy could be due to a number of factors. Perhaps investors are concerned about the overall health of the mortgage market.
Okay.
Maybe they're not fully grasping the potential of Rithm's unique business model. Or perhaps there are other risks we haven't considered yet. So it's a bit of a head-scratcher. A potential bargain, but with some unknowns surrounding it. It's a reminder that high yields often come with unanswered questions. Before we wrap up our analysis of Rithm Capital, are there any specific risks associated with their business model that we should highlight? Well, one inherent risk with mortgage REITs is their sensitivity to interest rate fluctuations.
Yeah.
We've already touched on how rising rates can impact their earnings,
Right.
but there's also the potential for prepayment risk.
Prepayment risk? What's that?
So imagine this interest rates fall.
Okay.
Homeowners decide to refinance their mortgages.
Right.
Those prepayments can disrupt the cash flow of mortgage-backed securities, potentially impacting Rithm Capital's earnings.
So they're exposed to risk on both ends of the interest rate spectrum.
Yeah.
If rates go up, their borrowing costs rise.
Right.
And if rates go down, they face prepayment risk. It's a tightrope walk for sure.
That's a good way to put it. And it highlights the importance of carefully assessing their risk management strategies and understanding how they navigate those potential challenges.
All right, so we've explored three very different companies,
Yes, we have.
all boasting these ultra-high yields, but each with its own set of potential risks and rewards. It's a lot to take in.
Yeah.
What's the key takeaway for our listeners today?
I think the biggest takeaway is this: high yields are enticing,
Yeah.
but they're not the whole story. It's
Right.
crucial to look beyond the flashy numbers and understand the underlying business, its strength, its weaknesses, and its potential for future growth.
Right. It's about peeling back the layers and understanding the engine that's driving those dividends. We can't just chase those yields blindly. We need to do our homework.
Exactly. And that homework should include considering the broader economic context.
Right.
What's happening with interest rates, inflation, and the overall market?
Yeah.
What's the outlook for the specific industries these companies operate in?
Right.
All of these factors can impact their performance and their ability to maintain those dividend payouts.
So it's about connecting the dots between company specifics and the larger economic landscape. It's a reminder that investing is rarely about simple answers. It's about navigating complexity and making informed decisions based on a holistic understanding of the factors at play.
Well said. And as always, we encourage our listeners to do their own research and consult with a qualified financial advisor before making any investment decisions.
Absolutely. We're here to spark curiosity and provide a framework for understanding these complex topics. But the ultimate decisions are always yours. Now, before we wrap up, I know you always like to leave our listeners with something to ponder. What's the thought-provoking question for today?
Here's one we've touched on throughout our conversation today.
All right.
If these companies are so profitable and paying such high dividends, why are their stock prices seemingly undervalued? What factors might investors be overlooking?
Yes. The age-old question of market perception versus underlying value. It's a reminder that the market doesn't always get it right. There's always the potential for hidden gems, companies that are flying under the radar or misunderstood by the broader market.
Precisely. And perhaps by digging deeper and challenging conventional wisdom, we can uncover those hidden opportunities.
Well, folks, that wraps up our deep dive into the world of ultra-high-yield dividend stocks. We hope you found this exploration as fascinating and insightful as we did.
Remember, knowledge is power. The more you understand about the companies you're investing in, the better equipped you'll be to make sound decisions and navigate the ever-changing market landscape.
Until next time, keep those brains engaged and those portfolios growing.
Well, one inherent risk with mortgage REITs is their sensitivity to interest rate fluctuations.
Yeah, we've already kind of touched on how rising rates can impact their earnings.
Right.
But there's also the potential for prepayment risk.
Yeah.
Prepayment risk.
Yeah.
Okay.
So imagine this interest rates fall and homeowners decide to refinance their mortgages.
Right, okay.
And those prepayments can disrupt the cash flow of mortgage-backed securities, potentially impacting Rithm Capital's earnings.
So they're exposed to risk on both ends of the interest rate spectrum.
Exactly.
If rates go up, their borrowing costs rise.
Right.
If rates go down, they face prepayment risk.
Yeah.
It's a tightrope walk, for sure.
It is a tightrope walk.
Yeah.
And it really highlights the importance of carefully assessing their risk management strategies and understanding how they navigate these potential challenges.
Absolutely. All right, so we've explored 3 very different companies,
Yeah.
all boasting these ultra-high yields, but each with its own set of potential risks and rewards.
Absolutely.
It's a lot to take in. What's the key takeaway for our listeners today?
I think the biggest takeaway here is that high yields are enticing,
Of course.
but they're not the whole story.
Right.
It's crucial to look beyond the flashy numbers and understand the underlying business, its strengths, weaknesses, and its potential for future growth.
Right. It's about peeling back the layers and understanding the engine that's driving those dividends.
Yeah.
We can't just chase those yields blindly. We need to do our homework.
Exactly. And that homework should include considering the broader economic context.
Yeah, for sure.
What's happening with interest rates, inflation, the overall market?
Right.
What's the outlook for the specific industries these companies operate in?
Mm-hmm.
All of these factors can impact their performance and their ability to maintain those dividend payouts.
Yeah, so it's about connecting the dots between the company specifics and the larger economic landscape.
Exactly.
It's a reminder that investing is rarely about simple answers. It's about navigating complexity and making informed decisions based on a holistic understanding of, all the factors at play.
Couldn't have said it better myself. And as always, we encourage our listeners to do their own research and consult with a qualified financial advisor before making any investment decisions.
Absolutely. We are here to spark curiosity and provide a framework for understanding these complex topics, but the ultimate decisions are yours. Now, before we wrap up, you always like to leave our listeners with something to ponder. What's the thought-provoking question for today?
Here's one we've kind of touched on throughout our conversation. If these companies are so profitable and paying such high dividends, why are their stock prices seemingly undervalued? What factors might investors be overlooking?
Yeah, the age-old question of market perception versus underlying value. It's a reminder that the market doesn't always get it right. There's always the potential for those hidden gems, the companies that are flying under the radar or misunderstood by the broader market.
Exactly. And perhaps by digging a little deeper, challenging conventional wisdom, we can uncover those hidden opportunities.
Absolutely. Well, that wraps up our deep dive into the world of ultra-high-yield dividend stocks. We hope you found this exploration as fascinating and insightful as we did.
Remember, knowledge is power. The more you understand about the companies you invest in, the better equipped you'll be to make those sound decisions and navigate this ever-changing market landscape.
Until next time, keep those brains engaged and those portfolios growing.